then I'm going to. Hi, everyone. Can you all hear me okay? Give me a thumbs up to confirm. Fantastic. So welcome to our monthly webinar. My name is Ben Driggs. DJ is here as my colleague. He helped set this thing up, so we appreciate him putting things together. If there are any technical problems, please let us know. So we'll go ahead and get started. For the next few seconds or so, while people are joining onto the call, let me just go over a few housekeeping things. First of all, we want to remind everyone that we do these monthly webinars. We record them, and then we post them to our website, so you can check them out later on our website. Also, we have started a podcast series. Every Friday, we're doing a podcast, and we've already done a couple of those. And then we have a few queued up for the next few months. We invite you to enjoy our podcast. And I know there's a couple of things. We really appreciate you taking time to spend time with us today to learn about different things related to finance. We hope we bring good content. And let's go ahead and start. Oh, if you have questions, just go ahead and send a question, and there will be a couple points during the presentation that we will pause for questions. For those people who are new and this is their first time listening to the webinar, just to give you a sense of how it flows, we will be prompt and we will end at past, so that people can count on us not going over time. There will be a couple of breaks for questions. In a minute, I'll start the presentation and we will go over the agenda and how things are going to play out today. I'm really excited about it. So I will go ahead and start. So let's go to what we're going to do today is we're going to be talking about retirement planning for the first about 10 minutes or so. And then we're going to pivot specifically to some tax questions and how it kind of makes sense of the different financial and investment accounts in our lives. So the first part is going to be creating a retirement plan. We're not going to be getting into a lot of those details, but I just wanted to introduce the idea of retirement planning. It's awesome. If you have not had an opportunity to spend a few minutes. Oh, by the way, we had this presentation at a client company yesterday. So if there are some people on the call who were at that meeting yesterday, I apologize. We're reviewing the same thing. So this is the second time we're making this presentation. At any rate, if you've not had a chance to go through a retirement planning exercise with us, we invite you to do so. It's very helpful. Throughout my career, I've done this hundreds of times, and I've never had that experience be anything but positive. It gives more clarity. Even yesterday afternoon, I was talking with someone, and we're going to schedule some time here next week to go over things. But she said, I just want to get a sense of, am I on track? What do I need to do? Have I saved up enough? Am I going to be able to retire when I want to? And what does that look like? So that's the purpose of a retirement plan. We will cover what goes into that, different considerations, and what it shows us, and how it can help us. So first of all, let's talk for just a minute about the considerations that go into a retirement plan. We're not going to discuss this in general, but as you can see, there are a lot of different things we factor in to the analysis. and some of it is subjective. A lot of it is generated by the computer. I mean, there are tools that we use, of course, for these types of things. But these are types of questions that we want to ask and need to ask in many cases to help make the analysis as accurate as possible. So some of the shortcomings, if you just go online and you do these things, they're good, but we want to probe a little deeper to see if there are some, other things that might be happening that a typical calculator isn't picking up on. So we are going to first start with a list, a bunch of questions. And then from there, we're going to run a retirement analysis for you. The analysis will help us look at a few things. It will help us look at retirement income. So you say, I'm going to retire at age 65. What does that look like for the next 25 years or something? That is one basic thing we want to do. We're not as concerned about net worth, right? So let's say you have you own a home, and that's an asset, and it's worth $500,000, and you owe $200,000. So you have $300,000 of equity on your home. We probably won't factor that in because you're still going to need to live somewhere. So we're really focused on the income side of things. We might factor in a home if you're planning to sell your home and move into a smaller residence, and you might be able to clear off a couple $100,000 in that transaction and then convert that real estate asset into some sort of a liquid asset that you can use that income. We would factor that in. We also it helps us to figure out your probability. This is definitely a probability kind of exercise. So we say, hey, there's a 90% probability you will never run out of money, for example. And that's kind of the way we approach it. We try to make sure that people are being realistic about their expectations in terms of how their assets will grow. We don't want to be too aggressive and too optimistic, but we still want to be as accurate as possible so that people can feel like they know where they're headed and whether they're behind or not. So the last thing here that I'm going to touch on is how it might help you. So it helps you determine when you might be able to retire, right? Maybe you can retire a few years earlier than you anticipated. Maybe you have to work a few years longer. It helps you make adjustments ahead of time. If you're tracking behind, then you need to save more, right? Or work a little longer. Or the other thing is maybe you're really doing well and you want to focus on some other things besides retirement planning. Maybe you want to focus on debt reduction, for example. It helps us figure out how much investment risk, because if we say, hey, if you get 5% and we assume a 5% rate of return, then you're going to meet your objectives. Then one school of thought would be, well, then let's try to get the investments to get 5% with the least amount of risk possible, right? But you might say, well, I've been getting 8% because I'm more aggressive. I'm comfortable with aggressive. Do I have to go down to 5%? No, but it invites a discussion to say, do we want to keep on being a little, making more money, recognizing that there might be a little more volatility and risk, or do we want to slow that down to get a higher probability of return? It helps us get a sense of how much we might leave to our beneficiaries when we pass away. And it helps us look at different income sources. We're going to be pulling from this much from Social Security, this much from our 401k, this much from our bank account. And, I have a rental property that's clearing $500 a month, something like that. Okay, are there any questions? And it is 10 minutes after the hour. we're tracking exactly as I had wanted. It's great. So let me look at a couple of questions. There's, let's see, 2 questions. What is the name of the podcast? The name of the podcast is If Money Could Talk. If Money Could Talk by Navigate Financial. How do we contact you about setting up a retirement plan? Just, you can give us a call. Our phone number is 801-905-1644. Or you could send us an email. My name is Ben Driggs. So it's ben.driggs@Navigate Financial, dj.bass@Navigate Financial. You've probably seen some emails come from us. And it doesn't cost any money. And we're not really trying to sell you anything in this process. There may be an opportunity from a business standpoint to say, hey, you've got this money. We would love to manage that money for you. And then you would pay us a fee to help you manage your money, perhaps. But really, these kinds of services are part of a working relationship, particularly if you're an employee of a company that we work with right now on the 401k side of things. This would be included. But it's really a starting point for all discussions, a basic retirement plan. There are a couple of other things we look at, a couple of other planning tools. We look at Roth conversion analyses. We could run that for you. We'll talk about that in a minute. Distribution planning, when you're actually getting to retirement, how's that going to be distributed in an efficient way? We have insurance planning, estate planning, different planning tools and conversations we can have. What is the recommended age to start a retirement plan? We want to start preparing for retirement by saving as young as possible, right? It's never too early to start saving. In terms of actually having a formal retirement plan that we talked about a minute ago, that really starts kicking in when people start turning 50, 55, 60. That's when it becomes more relevant. But even a young person in her 20s or 30s might benefit from going through the exercise, because they can mentally think, okay, this is a tool that people use to track, and there's a lot of data to support the argument that when you track things, you have a better result. So even going through the process raises awareness, makes us more conscious of these things, and in some sort of a cosmic way, it keeps us on track. So I would encourage anybody at any age to have a conversation about retirement. And also, lastly, before we get back to the other questions, is it kind of fosters other conversations. So although we might start with a retirement plan, it might kind of morph into a conversation about your debt and how we can be more efficient about helping you manage your debt, or insurance, or estate planning. Hey, we're talking about retirement planning, but have you done your basic estate planning? Things like that, so that all these things really kind of working together. That is it for questions. Let's get back to the presentation. Thank you so much for asking questions. So the next, and for the last 15 minutes, we're going to be talking about how these things all come together. We're going to be talking about different types of accounts, different buckets of where you have your money. We're going to be talking about investment objectives that people need to think about as they start investing money, and some questions that we might want to consider. So the first thing, let's talk about investment objectives, because what is often lost in the conversation is that people are very focused on one or two things. Like, it's like, if the fourth one down here is growth, right? So I've got to grow my money. I've got to grow my money. And there's a lot of pressure to grow the money. And so If they make money or they lose money, they're happy or sad, based on that. But there are other objectives that we're trying to balance. And we want to make sure that the way we're managing our money and the places we're putting our money are consistent with our investment objectives. So capital preservation, that means I don't want to lose money. That is a very high priority for me. Well, if that's a priority, obviously we're going to be more conservative. We're going to be talking about managing cash at the bank. How can we be effective and get the most yield or the most interest at the bank, or maybe an annuity or a government bond or a CD, different things like that. We're definitely going to be getting into the conservative cash insurance guaranteed type conversation. Liquidity is really important because we need to make sure we have some liquidity available for either offense or defense, right? So we want some savings there. And when I say offense, to go to school or to start a job, or start, an entrepreneurship, right? Like, hey, I want to start a little company, a side hustle, if you will, right? We want to hop on something positive. The defense would be something negative. So you lose your job, you get sick, you need to help a family member in distress, something like that. So whether it's offense or defense, we always want to make sure that there's some liquidity, and we can help you through that conversation. Either if you don't have liquidity now, how can we start building liquidity into your finances? And if you do have liquidity, is that liquidity being managed effectively? Income is retirement, well, it doesn't even have to be retirement. The most simple example would be if you own a real, a property, right? Real estate, second home or Airbnb or something like that. So that's an income source for you. Is that getting a good income for you compared to what you might be getting otherwise? Is that income being tax efficient for you? And that leads us to the next one. I'll skip over growth because that's pretty intuitive, grow your money. Tax efficiency is, particularly when the money is in a taxable environment, we want to be efficient, and we'll talk more about that in a minute. And potentially as you get later on in your life and you have extra money, even if it's just a little, where's that money going to go when you pass away? So the second thing we're going to be talking about is the different types of investment buckets that we may want to be putting our money in. And we'll just call those buckets because that's an easy way to look at it. So from a tax standpoint, and I think that's the best way to look at these different things, ultimately, all of your money and investments and assets reside in one of two buckets. It's either a taxable environment, a taxable bucket, or it's a tax deferred bucket. So taxable means that it is any interest or capital gains or dividends, growth, things that are being generated from that investment, whether that's real estate or 401k or interest at the bank. You have $1,000 at the bank and you give it $5 of interest. Those are getting taxed in almost all cases. So when you get taxed, you can do it every single year. You get a 1099 typically, and it said, hey, you made $100 of interest, and you have to pay tax on that interest every single year. That is a taxable environment. Again, cash at the bank is the most common. If you have a brokerage investment account, that's another example of a taxable account. The other are tax deferred, and those are investments that you don't pay taxes every year consistently. You only pay taxes down the road when you sell the investment or when you retire and you start taking money. The math pencils out in favor of having money in a tax deferred account. This is buckets 2 and 3, but it's basically one category, tax deferred, meaning you're pushing the taxes back as much as possible. So the big benefit of tax deferred, it grows more efficiently, and all of the things being equal, you want most of your money there, but it's not very liquid, right? So if you have all of your money in your house or in your 401k and you need $5,000 for some major dental work and you don't have that, then that creates a problem. So it's a balancing your taxable liquid stuff that you can get to and your tax deferred, which tends to be long-term. So these buckets, we subdivide the tax deferred into traditional money that you have a tax deduction now, which is a good benefit, but then you pay taxes down the road. The opposite of that is you pay the taxes now, get that over with. It doesn't cost you any extra money per se. It grows tax-free. You're not paying taxes, and it comes out tax-free down the road. That is referred to as after-tax money or Roth money, whether it's a Roth 401k, Roth IRA. That is really the best way for money to grow in the long term. So we're going to spend the last few minutes. Let me pause for questions. Are there any? Let me see. Okay. Yeah. How do you move money from one bucket to another? We'll spend the last 8 minutes on, and we'll talk about that here in just a minute. Let me see if there's another question. What if my investments in each bucket are the same? Is that bad? Should I be more thoughtful about the risk profile? Okay. We're going to talk about those questions right now. So here are some things that we're considering. How much money should I put in each bucket, right? So as a very simple rule of thumb, your liquid money is going to be in the first bucket, taxable. You just want your money, any savings at the bank. You can get to it easily, no big deal. Yeah, it's not going to be tax efficient. You have to pay little, taxes on the interest on that, but shouldn't worry about that. That goes in bucket 1. And then the other one is your retirement savings. So the question is, how much do I put in each one? I'm going to say as a very general rule of thumb, you want your taxable money, your liquid money, to be at a minimum some emergency savings, and ideally a little more than that. And certainly if you're saving up to buy a house, you're going to need even more than that, right? So you would first get some liquidity established. Then once you feel like, yeah, I've got some savings, I'm comfortable with the amount of savings I have generally, then you're going to focus on buckets 2 and 3. That's your long-term money, IRA, 401k, real estate. Those all grow tax efficiently. And that's where most of your money is going to go. That's where most of your focus is going to go. But there is a balance of going back and forth based on how much liquidity you have. So you have your basic liquidity. You switch over to your long-term tax efficient investments, and then you toggle back to the other one as needed. Number 2 is, should I move money from one bucket to the other? So let's go up to this thing here. So there are times, and we can help you through this. We don't have time to go through the merits of each one of them, but there are times that we want to move from taxable to tax deferred. That's usually when we're younger and growing the money. When we retire, we typically go the opposite direction. We're going to be moving out of the tax deferred accounts back into taxable, and that's what we're going to be living on during retirement. Now, another very significant potential move, and a very good one, is to move the money from bucket 2, which is the tax deferred pre-tax, move that over to the Roth. That's referred to as a Roth conversion. So let's say you have $100,000 in a 401k or an IRA in the traditional bucket. We've done this for many, many people over the years. Every single time it pencils out better to have the money in bucket number 3 in the Roth. So again, we want to make sure it's not absolute, right? So we can help you do the numbers and do an analysis. But like I said, in almost all cases, we're going to say, hey, it's probably better to move money from bucket 2 to bucket 3. What does that look like? Do we do that all at once? Do we do that over a 2-year period, 5, 10? We see it all over the map. But essentially, let's say you have $100,000 and you move it from bucket 1, 2 to 3, that becomes a taxable event. So you have to pay taxes on that. So you need to be thoughtful, like, oh, I don't have any money. Well, maybe we don't be that aggressive. But if you have some money to pay for the taxes, it would generally be better to move it, pay the taxes, and get that bucket into number 3 and never pay taxes for the rest of your life. Again, that's specific, to each person. So we need to be thoughtful about that. We have just a couple more minutes. Let me go back to this. How should I manage my investments in each account to maximize tax efficiency? So the tax efficiency is a big question. Again, let's go back to this. We've already established that bucket number 1 is generally less tax efficient than bucket 2 and 3, which is fine. But there are ways in which you can manage your investments tax efficiently in bucket number 1. So if you make extra money from your investments or you sell something, for example, ideally we want to defer that for as long as possible. That's what we're talking about. Avoid paying taxes for as long as possible is the general rule of thumb. And there are strategies we can talk about to help you in bucket number 1. In bucket number 2 and bucket number 3, you don't pay taxes on that. So you can buy, sell, grow. It's very easy to manage money there from a tax efficiency standpoint because you're already in a tax efficient environment. One more question, or the minute before we wrap up, how do I withdraw my money in the most efficient way from a tax standpoint? Again, that's down the road. You're retiring. For those people who are on the call or know people who are in retirement, we want to be thoughtful. There is a strategic and tax smart way to take money. Let's say when you retire, you have money bucket in bucket 1, 2, and 3. Well, there's a strategic way. You may not do, like, it's not like an obvious thing. We may want to be taking from one bucket first, then another bucket second, coming back to the other one based on your individual tax situation. So we can help you through those kinds of conversations, even though we do not offer tax advice. We're not accountants, but we can kind of help you through these general tax-related questions. So with the last slide, thank you for joining us. Here's some contact information. Again, you can email us at navigatefinancial.com, give us a phone call. You can follow us on Instagram. We do, regular posts, and we have these monthly webinars, these podcasts. We really appreciate your business. Here is a disclosure, and you can see this read the full disclosure on our website. It is 10:30. Let me see if there's any last minute questions before we hang up. No questions. Perfect. Thank you all. Have a wonderful Thanksgiving. We are thankful to know you. We're thankful that you be on the call. For those of you who are clients, we appreciate your being clients and the relationship we have with you. Best wishes to everyone. Until next time.